Sam Stovall is joining us from CFRA. He's the Chief Investment Strategist out with an Outlook report. Sam, good to have you on the show, sir. Good morning. What's the biggest message that you want readers to take away from your analysis of what to look for in 2021?
Good morning, Oliver. Well, I think first off is to realize that we got back to break even on August 18th of last year from the 34% bear market. And that was the third fastest on record. History then implies, but obviously does not guarantee, that we've got another 3 years to go in this bull market. So while it could end up being choppy along the way, and I do think that we're due for some sort of digestion of gains, I think that over the long term, we will remain in a bull market mode.
Sam, so what's that based on? It is the 3 years that you mentioned. That's just kind of the standard length of a bull market after you break out of a bear one, or what?
No, what I did was I went back to 1932, the first bull market after the great crash of '29, and then basically said, how long does it take to get back to break even? Usually it's about 14 months, but this time it took us only 5 months, which was the third swiftest on record. Then the question was, okay, how long until we fall into another bear market following the getting back to break even? And that was where I got the average of 36 months, median of 24 months. So at least 2 years down the road on the median, 3 years on the mean, to give me some guidance. Obviously, it's not gospel, but guidance as to how long this bull market could last.
Okay, and that's based off the median performance following the other three instances in which we snapped back this fast?
No, actually, it's based on all of the bull markets. How long did it take until we fell into a new bear market? So basically trying to get as many observations as possible, because really 2 or 3 observations are not statistically significant.
Right. Sam, here's the question, though. I mean, is there anything comparable to one? I mean, it sounds like the speed of the snapback, there are 3 comparable instances. But what about the nature of us beginning a new economic cycle, as some are calling it, at all-time highs for valuations? Has that ever happened? I mean, it hasn't, right? I know it hasn't, because I looked at the chart of valuations. The only time we've ever been this high is in 1990, and that wasn't at the start of a cycle.
Well, 1990, true. We did fall into both a bear market and a recession simultaneously in late June, early July of that year, as Saddam Hussein rolled into Kuwait. But then we got out of that bear market in December very quick and got back to break even, also pretty quickly.
Sorry, I meant 2000, the peak of the dot-com bubble. I apologize, I misspoke.
You were just trying to test me, that's all. But I would actually say, yes, usually all bear markets are different, but the one thing that is consistent is human involvement, basically looking at emotions, looking at opportunities, etc. Yes, there are a couple of things that cause me concern right now in terms of valuations for the overall market. We're at a 40% premium to the average next 12-month PE over the last 20 years. Second, growth versus value. We hit an all-time high differential back in August of this year, higher than where we were back in the tech bubble. And right now, the Russell 2000 is 34% above its 200-day moving average, the highest differential going back to the index's inception in the 1970s. So yes, like the advanced column that is moving well ahead of its supply line, we've got to pretty much hold up and wait for food, fuel, and ammo to catch up.
So Sam, to conclude then, it's kind of hard for us to get a lot of historical indicators, right? I mean, I know we've come out of bear markets plenty before, but with the amount of vigor and froth in the market right now is kind of unprecedented, right? Because a lot of people will say, hey, we're beginning this new economic cycle, and generally when we come out of recession, here's what you expect for the market, XYZ%. This time around, though, we're already at highs in valuations at the start of this economic cycle.
Well, I think that it's because the market is looking across the valley. The difference between Wall Street and Main Street is that Main Street looks at today, Wall Street focuses on tomorrow. And if we're looking for about a 5+% gain in GDP next year, we're looking for an increase in earnings of at least 20% for large caps, more like 40% for mid caps and 75% for small caps. Also looking at near 40% gains in earnings for developed and emerging markets. It's not just a U.S.-based recovery. It is a global recovery. So I would take a look at the upcoming indicators popularized by the Stock Traders Almanac, looking at the Santa Claus rally the first 5 days of January, look to the January barometer, because those three indicators together, if they're in positive mode, has signaled an up year 88% of the time since World War II.
So, Sam, yesterday we talked with Tony Dwyer, and we talked about the idea of valuations versus price and the idea that the NASDAQ with high valuations could underperform in a market that is rallying based on earnings. So his point was, look, don't expect a crash because we're going to have earnings growth. But if we have valuations flat or contracting, then that might mean a different dynamic than what we've been used to. The last couple of years have been all valuation expansion, right? So I want to combine these points, because what you're talking about here in terms of GDP, how important is the actual economic growth going to be to the stock market? Because you could argue the last 18 months, even before COVID, expansion, multiple expansion was what 2019 was about. You could argue that the economy was kind of second most important to policy, right? Is that going to change next year, where this GDP number needs to either meet or beat for us to keep rallying?
We need it to beat, not just meet. My opinion is that the reason that the market has been going up is because everybody knows that 2020 was going to be bad. It's going to be a kitchen sink year, most definitely. And so what the real question is, what about 2021? And I think that right now, even though earnings estimates are for a shade below $170 for the S&P 500, we're probably going to need to see earnings approach the $200 level in order for investors to feel as if they're getting their money's worth. So I would tend to say that as we move toward the second half, we're going to have to see an upward ratcheting of estimates for GDP and for full year earnings in order for this bull market to be maintained.
Okay. Sam, in terms of now the sector dynamics as well, are there standout sectors that can lead in a market where the dynamic is more about fundamental growth than monetary policy?
Yes, I think so. Certainly, the reason we had growth do so well is because interest rates were trading below 1%. So I would tend to say that we're likely to see the rotation into value really sort of gather some steam. We do have overweight recommendations on some of your traditional cyclicals, like industrials, like materials, which would benefit from infrastructure spending as well as an increase in the inflation rate, consumer spending because of the likelihood of pent-up demand, and then also we have an overweight recommendation on healthcare, just because we figure this is now the time for healthcare to be outstanding. So also we're in a favorable seasonal period for cyclical sectors, November through April. The average performance for consumer discretionary, industrials, materials, and tech has beaten the market by an average of 250 basis points every year going back to 1990.
Okay. All right, Sam, good conversation. Really liked it. And I like the heads up for healthcare, too. We hear a lot about banks, a lot of the cyclical stuff. I like the idea of healthcare being a big part of next year, too. Sam, thanks for the thoughts and the details, as always.
All right, good to talk to you. Bye, Oliver.
Thank you, Sam Stovall, Chief Investment Strategist at CFRA.